Good morning, everyone, and welcome to our webinar regarding the annuitization of provident funds that will come into effect as from 1 March 2021. This is also referred to as the retirement reform, or in some cases, T-Day. You may have already read about this in the media, or perhaps you have read our newsflash that was distributed earlier this year regarding this. But this webinar will provide you with all the information that you require and allow you the opportunity to ask any questions that you may have. If you do have any questions during the course of today's session, you are welcome to make use of the Q&A box that is available in this session to post your questions there. We will deal with your questions at the end of the presentation, and if there are too many questions, we'll make a summary and that will be emailed to all of the attendees of today's session. I also have with me in the session my colleague Eureka Prinsloo, who is an account executive to some of our largest clients at PSG Wealth, and she will be monitoring the questions during the course of the session and also posting some of the answers. Otherwise, if we do have enough time, we'll deal with the questions after the session. But before we move on to the agenda, I just think our most important message for today is that we don't want you to panic. And we think the aim of this presentation is to tell you more about it and to put your mind at rest as to what exactly the changes are going to be. So just look at the contents of today's presentation. We're going to just remind you what our role is as PSG, as your advisors. We will take a look at exactly what the aim of the retirement reform is and what this entails, as well as the alignment of the tax treatment of the contributions that actually already came into place as from March 2016. We will look at the annuitization of the provident funds, and then lastly, what has changed in terms of access to your funds on immigration. So let's look at our role as PSG, as your advisors. So we would ensure that you fund and your risk benefits are with competitive administrators in terms of price and the level of service that they offer. We are unbiased advisors, not only linked to a specific insurer or administrator. So we can get quotations from various insurers and administrators in the industry and provide our clients with full quotes and alternatives if that would be the need of the client. We also assist in advice on the portfolios that the employer invests in, along with the Provident Fund Committee at the employer, and help them to make the decision with regards to the correct portfolio to invest in. We provide financial advice to members in terms of their personal portfolios. So besides looking after your retirement fund, we do also have financial advisors that can help you in respect of your personal portfolios. So if you're not sure if you're making enough provision for retirement, you have enough life cover, disability, whatever the case may be, you can speak to us and we'll put you in touch with an accredited phase financial advisor that will be able to help you with advice in your personal capacity as well. Then we also advise employers on changes in legislation that will have an effect on the risk and retirement benefits, as we are doing for you today, and on request when entering or exiting the fund, and provide them with the necessary advice. So that's just in a nutshell what we do. We do a lot more than that as well, but just to remind you what our role as the employer benefits advisor for your fund is. So let's move on to the main aim for today, which is to tell you what is this retirement form that you've been reading about and how is it going to impact you. So firstly, it was actually initially recommended in 2015, March of 2015, and then it was postponed to 1 March 2021, so it will be coming into effect as from next month. A part of the changes did already come into effect March 2016, which we'll show you shortly. But the main aim of the retirement refund reform is to protect South Africans in some way against poverty, to make sure that citizens contribute enough throughout their working lifetime, and then ensure that the retirement system offers members value for money. So protecting South Africans against poverty just means that at retirement, the people need to be looked after when they need it most. So by capping them on the amount that they can take as a cash benefit, that will help to do that. And then making sure that citizens contribute enough so you get a tax deductible benefit on your contribution, making it affordable and inviting to actually save for retirement. If you need more information on the tax deductibility, we are going to touch on that further on in the presentation as well. So the ultimate goal is really to encourage members to save more, to ensure a better retirement, and to ensure that they have enough income after retirement that will last them their full lifetimes. So the three main changes that are taking into effect is the alignment of the tax treatment of the contributions that already came into effect March 2016, which we'll show you. The annuitization of provident funds, which is the big one that's causing all the hustle now, which will explain to you exactly what that impact is going to be on you, and then the access to your funds upon emigration. I just want to take you through the memorandum that was included in the Taxation Laws Amendment Bill of 2013 by National Treasury. And forgive me, I am going to read this and then I will explain what it means afterwards. But it says a strong link exists between insufficient retirement income for retired members of provident funds and the lump sum payouts made by provident funds at retirement. In short, the absence of mandatory annuitization in provident funds means that many retirees spend their retirement assets too quickly and face the risk of outliving their retirement savings. In view of these concerns, it is government's policy to encourage a secure post-retirement income in the form of mandatory annuitization. Now that is a mouthful. So just to summarize that for you, basically what it means is when people have access to their full funds at retirement, the majority of them tend to cash out that full fund. They don't spend it wisely, and at the end of the day, they run out of their savings before their lives are over. So there is not enough savings to last them their full lifetimes. And then they have to either rely on family members or a second income after retirement or on the government grant, obviously. So that is basically what the main aim of this is to ensure that people have a sufficient retirement income. So as I said, the change that came into effect on the 1st of March 2016 is the alignment of the tax treatment of contributions. So prior to March 2016, the pension and provident fund contributions were treated differently in terms of tax deductibility. And the employee contribution for a pension fund, you could only get up to 7.5% of your retirement contribution as a tax deductible benefit, where employers could get 10%. On a provident fund for members, there was no tax benefit. For employers, it was also 10%. And on a retirement annuity, so retirement annuity is a retirement fund that you have in your personal capacity, not linked to your employer, that is up to 15% of your taxable income you could get as a tax deductible benefit if you were saving it in a retirement annuity. Now, what changed from March 2016 is that the tax treatment of contributions between pension and provident funds, as well as retirement annuities, was aligned. So it's treated in exactly the same manner. So it doesn't matter whether it was an employer or an employee contribution, you would get the tax deductible benefit on both, up to 27.5% of your income, with a maximum of 350,000 Rand per annum. It's just important to understand that that is not saying you're not allowed to save more than 27.5%. It's just saying that the maximum tax deductible benefit that you can get is up to 27.5%. So it does make it very attractive to save for retirement. So let's show you an example in principle of what I'm telling you now. So understanding this 27.5% tax rebate, this example will simplify it for you. So it doesn't matter whether you're saving it into a pension fund, a provident fund, or a retirement annuity. You can get the tax rebate on all of them up to 27.5%. So for example, if you have a 10% contribution at your employer and maybe you have a retirement annuity in your personal capacity that equates to, let's say, 5% of your income, that would be 15% in total. So you can get the tax rebate on both of those because it does not exceed the 27.5%. If we look at the example, this member is earning 20,000 Rand per month. I'm just going to look at the middle one, where they contribute 17.5% of their income. So what happens is, before you are taxed, they first deduct your retirement contribution, which in this case at 17.5% is R3,500, and then they taxed you. So instead of this person being taxed on the full income of R20,000, they're only taxed on R16,500 because the provident portion of their income is tax-free. I hope that makes sense to all of you, but as I said, please feel free to post your questions in the questions and answers box if you do have any. So let's move on to the big change that's happening now with effect from 1 March 2021, which is the annuitization of your provident fund. So basically, I think what's also important to understand, I'm not sure if we do perhaps have any members that are on a pension fund in our session, but should there be anybody that is on a pension fund in our session, it's important for you to understand that there's no change to you. This has always been in place for pension fund members. So the change is only applicable to members that are provident fund members. So on a pension fund, you at retirement are not allowed to access the full amount in your fund as a cash benefit. You can only get 1/3 of that amount as a cash benefit subject to tax. And the other 2/3 you have to invest in a living annuity for your monthly income. So basically, a provident fund is going to work like that going forward. So there you can see the 1/3 you will be able to take as a cash benefit on a provident fund, and the other 2/3 you will have to invest in a living annuity that will give you your monthly income. But before 1 March 21 on a provident fund, you could take your full amount as cash. So that is the main change that is happening with effect from 1 March 2021. There are, however, a few things that you do need to bear in mind. So your age has an impact. If you are under the age of 55, you will now, going forward, as from 1 March 2021, have 2 records at your retirement fund administrator. In your account 1, it will contain all of your assets up until 28 February 2021, plus the growth on those assets, and that will be known as what we call your vested benefit. Now, the different administrators might have a different term for that, but let's call it, for the purpose of this session, a vested benefit. In account 2, if you are under the age of 55, in account 2, you will have all of your future contributions after 1 March 2021, plus the growth on those contributions. And the annuitization will only be applicable to that portion, which is known as your non-vested benefit. Again, some of the administrators might have a different term for it. So your vested benefit, contributions and growth, balance and growth up to 28 February is vested benefit. At retirement, you can still get that amount as a full cash benefit, obviously subject to tax. Contributions after 1 March 2021, plus the growth on that, you will only be able to get 1/3 as a cash benefit, and the other 2/3 you would need to invest in a living annuity for your monthly income. If you're older than 55, you can almost, you can almost relax, because this does not have an impact on you. As long as you stay in the same fund that you were in on 1 March 2021, they will not have to create the 2 accounts for you as they do for members that are under the age of 55. So the 1/3, 2/3 restriction will not apply to you if you are younger than the age of 55. But if you transfer to a new fund before you reach the retirement age, so you are already 55 on 1 March 2021, the annuitization rule does not apply to you unless you transfer to a new fund. So let's say you are 57 on 1 March 2021. Now, when you turn 59, 2 years later, you decide to change employment and then move to a new fund, and you're going to transfer your benefit over to your new fund. At that point, the full amount that you have at that point, in other words, at age 59, will be your vested benefit. So the full amount in your current fund will still be your vested benefit, but your new contributions to your new fund will be seen as a non-vested benefit. In other words, subject to the 1/3, 2/3 rule, and then you will have the account 1, account 2 scenario, but only on new contributions and only if you change funds before you reach retirement age. So what happens if you resign? I think this was the thing where people started to panic. And we just want to tell you don't have to panic. Because if you resign, this does not have any impact on you. You can still get the full amount as a cash benefit. We obviously don't advise that. But if you would want to take the full amount as a cash benefit, you can get that subject to tax. We really like to encourage our members to rather speak to a financial advisor at resignation stage to get the best advice in terms of what they should be doing with the balance in their provident funds. Every time that you change jobs and you cash out your retirement fund, you're setting yourself back in terms of your retirement planning. So rather speak to a financial advisor and get the proper advice as to what you should be doing in terms of that balance in your retirement fund. So the main message, as you will recall at the beginning of the presentation, I said our main message was hopefully to tell our employees, our members don't panic. We've got this. So that is why we are saying this. If you are resigning, there's no impact on you. You can still, if you would like to, get that full amount as a cash benefit. So the change comes in, as I've already explained to you, only at retirement age. The 1/3, 2/3 rule will apply on your non-vested benefit. In other words, contributions from 1 March 2021 plus the growth on that onward. The vested benefit you can still get as a full cash benefit. If you're over the age of 55, there's no impact on you unless you change funds. And that's the main change. We're going to look at the access to funds on immigration next, which is the other minor change that was made as well. But that is the change that has had everybody concerned that you've been reading about in the media. So I hope I've put your minds at ease that it's really nothing to panic about. But please post your questions in the questions and answers box, and we can look at those for you afterwards. We are almost done with our session now. So the last change is then the access to funds on immigration. So prior to 1 March 2021, if you are immigrating, you can get the full amount as a cash benefit if you're immigrating. But as from 1 March 2021, if a member immigrates, a full cash withdrawal from a preservation fund or a retirement annuity will only be allowed when the individual has been a tax non-resident for a period of 3 years or longer. Important to note here, we're only talking about retirement annuities and preservation funds. So in other words, your employer retirement fund, your provident or your pension fund, this is not affected by that. If you're immigrating, you will still be able to get your full amount as a cash benefit on your employer retirement fund. Only on your personal retirement annuity or your personal preservation fund, this change is taking effect. Okay, and that is all that we have for you today. There are our contact details. If you don't want to post your questions in the questions and answers box, you can give us a call and speak to your consultant, or you can send an email to that email address, and we will be able to deal with your questions on email or telephonically as well. So let's hand over to Eureka, who is monitoring the questions for us, to see if anybody does have any questions.
So just inquiring whether they will be able to see the vested and non-vested amounts on their benefit statement. So is that something that the administrators will be splitting? Do we have confirmation on this yet?
Yes, the administrators have all been instructed to have a separate record for each member. Being, if you recall, in one of our slides, we did show there was an account 1 and account 2, which is your vested and non-vested benefits. So employees and members will definitely be able to see what is my vested benefit and what is my non-vested benefit. It is a requirement for administrators to show that separately on the members' statement.
Okay, and some employees are just interested in the tax that you pay on your 1/3 withdrawal. So if you can just give us an idea about the tax payable.
Okay, I'm assuming they're referring to when they are retiring. So there's a tax sliding scale that is applicable. If it is less than 500,000 Rand, there's no tax applicable. And after 500,000, a specific tax scale will apply, depending on the amount that you're taking as a cash benefit. If the amount is less than 247,500, the 1/3, 2/3 rule would also not apply to them. So say, for example, your non-vested benefit is less than 247,500, then the 1/3, 2/3 rule would also not apply. But your first 500,000 at retirement is tax-free, and then after that, you're taxed according to a sliding scale. So if employees would like more information on exactly what that sliding scale looks like, they can pop us an email and we will get that through to them.
Wonderful. So the questions are coming through quite quickly. A number of employees are asking how can they access benefit statements. So if I can just answer that one while we're addressing the benefit statements. So the contact details are on your screen at the moment. We have that PSG EB mailbox. And what we would suggest is sending an email through that we can assist you to register on the portal for either Momentum, Old Mutual, Discovery, whoever your Provident Fund is with. We prefer assisting members to obtain their own benefit statements so that you can have access to this information anytime that you need. But please send an email to the email address on your screen at the moment, and we will assist you to obtain a statement and then to register on the different portals. Giselle, employees are asking, what is the withdrawal from the Provident Fund still limited to a once-off withdrawal?
From a preservation fund or a provident fund?
So I think address it in both. Maybe is from a preservation fund, do we still just only have one withdrawal? And then can I withdraw from a provident fund while I'm still employed at my current employer?
Okay, so let's first deal with the second part of the question. If you are still employed at your employer and still a member of the Provident Fund, you're not allowed to make a withdrawal or a loan against that Provident Fund. It is unfortunately legislated that way. So it's not your employer's rule or PSG's rule or the administrator's rule. It is legislated that it is compulsory for members to belong to their provident funds, as if that is what the employer requires, and that they have to remain members of those provident funds and not make any withdrawals while they are still employed. So the only time you have access to your provident fund as a cash benefit is at resignation and at retirement. And then depending on your situation, the 1/3, 2/3 rule could apply to a portion of your balance. To answer your question on a preservation fund, let's just quickly recap again on what a preservation fund is. So a provident fund is your employer's fund. You're contributing towards your employer's retirement fund. That is a provident fund. A preservation fund is normally taken when an employee leaves the employment of the employer, does not want to cash out his benefit, so he preserves it in a preservation fund. Similar to a provident fund or a retirement fund that's linked to your employer, excepting that on a preservation fund you do not make ongoing contributions. It's only the balance that's in your fund, and you obviously are earning interest on that balance or investment returns on that balance in the preservation fund. Now, the rule of the preservation fund says you are allowed to make one withdrawal from that preservation fund before you reach retirement age, and the earliest that you can be seen as retirement age is the age of 55. So you're only allowed to make one withdrawal from that provident fund before the age of 55 of either the full amount or a portion of the amount. Just remember that any time that you take cash, it is subject to tax. If it's your first withdrawal from a retirement fund, the first 25,000 is tax-free, and again after that, a specific tax scale will apply. If you would like more details regarding that specific tax scale, again, you can pop us an email and we will be able to give you the tax scale that applies at retirement and resignation for cash withdrawals. I hope that answers the question.
Yes, that certainly does. There is a concern that we would have to be completing new beneficiary nomination forms, that we're going to have to split a nomination to say this portion of the vested goes to this beneficiary. Do we foresee any problems with that in terms of completing beneficiary nomination forms?
No, the beneficiary nomination form would be seen as a whole. So you don't have to complete a separate beneficiary form for the vested or the non-vested benefits. In the event of your passing, it would be seen as one, and that can get paid to the beneficiaries in line with your beneficiary nomination. So you only need one beneficiary instruction. Just remember, if you have a provident fund with group life benefits linked to that provident fund, it's important that you have an instruction in place for both your provident fund as well as your life benefit. If it's what we call an unapproved life benefit, I'm not going to get into that now, otherwise it gets very technical, but if there's no instruction in place for your life benefit, that benefit automatically gets paid to the estate. Your provident fund redistribution is decided by the trustees of the retirement fund. They will look at the financial dependency of your beneficiaries and your dependents, and that's how that final distribution will be decided in line with what you've put on your beneficiary nomination form. But just be sure that you have an instruction for both your provident fund and your life benefit in place, so that the benefits can be paid to your beneficiaries as you would wish to. And remember to keep it up to date as your life situation changes. So life events can be marriage, divorce, the birth of a child. Anytime that your life situation changes, it may be necessary for you to just review your beneficiary nomination. We find so often that employees complete their beneficiary nomination forms when they join an employer, and then they kind of forget about it. And later on, they get married or they get divorced and they have children, and they've still nominated mom and dad way back when they were single, 50-50 for mom and dad, and then they pass away and there's no new instruction in place. So it's important, firstly, to make sure you do have an instruction in place for both benefits and that you keep that up to date.
Giselle, in terms of administration fees from a provider, are we going to be paying duplicate fees? So will I be paying an administration fee on my vested rights for them to manage that, and another administration fee for the non-vested? So will I be doubling up on this because the administrator now has to do extra work to manage my funds for me?
Now remember, your administration fee in most cases, it's either a rand per member amount or it is a percentage of your salary. So the balance in your fund on the administration fee is not going to have an impact, or the fact that you have two balances. So the administration fee is either calculated as a percentage of the salary or as a rand per member, depending on what the arrangement is between the employer and the administrator. So you will not pay a double administration fee. Eureka, I'm not sure if that's answering the question. You can elaborate if you think I haven't answered properly.
That is perfect. So I'm going through the questions, and we have a number of members asking about so growth on portfolios and tax. What will tax be in this scenario? What would tax be in that scenario? It's difficult to answer those questions in this forum, but we will definitely address those following the presentation. I think we have dealt with most
common ones.
The most common ones. We do have someone asking, where can we obtain forms to update our beneficiary nominations? Please, if I can ask you to send an email through to us, psg-eb@psg. We will then assist you. There's, with giving you forms, helping you to register again, because you are also able to capture your beneficiaries online, which is always always a safer option, because there's no chances of forms getting lost. So in terms of beneficiary nomination forms, and just please, if there's anybody that needs to get hold of us, you've got our contact details, more than welcome to pop us an email. We just really ask, include your email, your ID number and your contact details and your employer, so that we can assist you efficiently and get back to you as soon as possible. But that is it from us, from my side. So I think the rest we'll address one-on-one. Thank you so much, Giselle. We really appreciate your time. It has been great listening to you. And thanks for all the attendees.
Always a pleasure, no problem, Eureka. And thanks for all the insightful questions from our attendees. It's always great to know there are people out there and they are listening and they have good questions. And by you asking questions, some of the other people that were maybe not comfortable to ask questions have learned as well. So we really would like to thank you for your time. Thank you for attending this session. And again, thank you for your insightful questions. If there are questions that we haven't dealt with, we will compile a document and send it to all of the attendees that did attend this presentation. So thank you everybody for your time, and have a wonderful day further.